talk more about what's happening with the markets, I want to bring in Jay Woods. He's the Chief Global Strategist at Freedom Capital Markets. And let's talk about what's in store for markets as we approach the end of 2024. And I know that before we talk about, well, I guess the end of 2024 also will be bleeding into 2025, because you're saying it's going to get a little rough.
It could get rough. Yes, we're in the midst of the Santa Claus rally, as you so astutely said at the beginning of the broadcast, which is the last 5 trading days of 2024, the first 2 of 2025. Historically, that's a very good time. The volume is very light. It's kind of slow when you look behind us on the floor. Not a lot of people here. But as we go into 2025, there are a few question marks. The rally has stalled a little bit, and that has me slightly concerned that we may stumble out of the gates. Doesn't mean we're going to, have a bad year, but given the fact that the market breadth, meaning advancers versus decliners, has been so in favor of the declining sectors, and we've been carried by some of the mega caps, I think we could see a mini correction, maybe even upwards of 8 to 10% as we kick off the first 6 to 8 weeks of the year, and then smooth sailing after that. That's what I hope.
So what is it that we're not going to see a Santa Claus rally then? I mean, we're going to be correcting 10%.
Well, 10% over 6 to 8 weeks, so Santa could come still by the technical definition. Yeah, we've had 2 back-to-back 25% plus years in the S&P 500. So we've been on a tremendous run, and during that time, on average, every 18 months, you get about a 10% correction. We haven't had one since October of 2023. Right now, the way we've stalled at this level, going into a lot of uncertainty. All right, we have a new administration coming in. We have tariffs about to be levied. Not sure the extent of that. The leadership has been great. It's those big cap stocks, but they're starting to tire, and under the surface, 8 of the 11 primary sectors, which are basically minus technology, have been struggling. So if they can't rotate into those sectors, we may struggle for the next few weeks. And then if we do, I think it sets us up for a good buy the dip opportunity.
So specifically, you're talking about the Mag 7. So how do you see that group performing into the new year or throughout the new year?
Yeah, I think technology is still going to be the story going forward, the AI story being front and center. We focus so much on the CapEx. How much are they spending in the technology to enhance it? Now we want to see results. We saw from one of our great companies down here, Salesforce.com, symbol CRM. That stock jumped after its last quarterly report based on what? AI, their implementation of AI. So to me, that's what we want to see, is a lot of these software related stocks start to really come to the forefront. You see it with Salesforce, Oracle, Palo Alto Networks. That's where I think the strength is going to be in 2025.
Yeah, we have seen tech as really the second best performer in the S&P 500. Communications taking the top spot.
Yep.
What other sectors do you see taking the lead in 2025? And then what sectors in 2025 do you see actually taking a backseat?
Yeah, well, I think financials definitely are going to continue on this run we've seen. Last week, the banks were trying to sue to pull back some of their stress test regulations. But for me, the financial sector has been strong this year. And when the financial sector moves historically, you follow an ETF like the XLF. The XLF has been around for 25 years. 15 years it's been up, 10 years it's been down. So its track record is a little iffy. But when it's up over an average of 22%, 27% this year, maybe a little more. I think maybe 30. But it tends to go in groups. And then the part of the financial sector I liked, we're going to see M&A activity pick up. Look for the regional banks. We haven't seen the regional banks acquire other regional banks, in good times. We've seen some stressful times in the regional banking crisis, but I think the regional banking crisis, IPOs coming back to this place, will be very good for the financial industry overall.
Yeah, and let's talk more about the financials itself for 2025. Do you see them coming strong at the beginning of the year, knowing that you're predicting an 8 to 10% correction?
Yeah, I think what we're going to see is a little trepidation out of the gates, like I said, and we want to listen to those conference calls very closely. One of the things you're going to hear about is the strong dollar and Forex, foreign expenditures, and how the countries with multinational reaches, there's a lot of the consumer staples, how the strong dollar is affecting their bottom line. That's going to be an interesting storyline to watch. Tariffs, again, we don't know the implementation of it. And then Doge, Elon Musk and Ramaswamy, can't say his first, Vivek Ramaswamy, I can't say his first name. They're going to be cutting a lot of fat, if you will. That means jobs. And what kind of impact will that have? Because the Fed is watching 2 things, unemployment and inflation. And the 2 things that they want to kick off this administration with, will have an impact on both of those things.
You know, when we did see the election come to pass, we now will have President Trump in office soon. There was a huge amount of exuberance in the market. We're seeing that fade. And he was elected based on his expected policies. And we're talking about the tariffs that you're mentioning and immigration. So now you're seeing it actually turn not in favor of the markets, or do you see that kind of filtering through as the year goes on?
Yeah, I still think we're in the hangover phase from that little rally we saw in the beginning of the election cycle. What happened was financials jumped. They're pulling back a little bit. The S&P 500 was up 4%. It's now up 3%. So overall, we're still above that level. That, as a technician, is a key level to watch, and I'm glad you brought it up. This 5850 level in the S&P 500 is where we gapped after Election Day. We got back down there on the last sell-off. We held. We've rallied. We haven't made a new high. I'm a little concerned about that, and I think we're going to retest that level and possibly breach it. And for technicians out there, geeks like myself, watch the 200-day moving average, which would give you an 8 to 10% correction around 55.50.
How concerned are you that inflation is going to remain really sticky throughout the year of 2025? And of course, we are seeing the Fed throw more caution in.
Yeah, I think sticky is stubborn is another good word to talk when you mention inflation. To get us down to that 2% mandated goal that the Fed throws out there, I don't really know where they get these numbers from, but I think we're absorbing a new normal. I'm watching the 10-year closely because the yields have gone up 100 basis points since we cut 100 basis points. We are at 4.6% in the 10-year, 4.7 is the annual high. If we break out above that, then everyone's going to be talking about 5%, and that should have a negative impact on the markets. And if that happens, we're close to it now. When would it happen? In the next 6 to 8 weeks. So that kind of feeds my narrative that we could see, a garden variety correction of 8 to 10%. Not the end of the world, but when you live through it, it's not fun. And then you wonder, how long is this going to last? Is this the real one, or is it just a correction in a very nice bull market we've had?
Yeah, we're going to bring you back a little bit later in the show, but your quick prediction for what you see the Fed doing as far as rates go.
Fed, they're going to pause. They're going to see what the administration policy does, how that will impact their policy going forward. But definitely a pause at the first meeting, and then we'll see what happens after that.
Okay, you're going to come back. We're going to dig in more about the Fed when you come back. Jay Woods, Chief Global Strategist at Freedom Capital Markets. Thanks for your time.
You got it.
All right, let's move on. And joining me now again is Jay Woods. He's the Chief Global Strategist at Freedom Capital Markets. He joins us once again. I'm glad you're back because I want to get into a couple of other topics. Also, the Fed we'll get to. First, we're looking at 2025, and I think AI is still the story. But what will investors really be looking for when it comes to AI?
Well, they want to see exactly where AI takes us. It's another industry. Reminds me of the 90s, for us older folk, and the internet invention, and what kind of economy that created. It's going to enhance a lot of the biggest big cap stocks like an Apple, artificial intelligence, AI, Apple intelligence. That's slowly being incorporated into the phone. If you watched Netflix yesterday and you saw the football game, there was a lot of Google ads for Gemini. That's their AI enhancement. So to me, it's going to be implementation of AI, how it becomes a fabric of our lives, so to speak, and that will basically bode well for the mega caps that are already implemented. And then you have to dig deeper and research some of those smaller cap stocks that are behind that implementation. And there are a few on the sidelines that could go public here at the New York Stock Exchange later in the year. We'll see, like ChatGPT, not public. Perplexity AI, not public. So there's a lot coming in that story, and I think that will still be the story for 2025.
So we're wondering if small caps is going to be the story as well, because given that interest rates moving lower, small caps are expected to perform better next year after they've underperformed the broader market in 2024. Do you agree with that?
Now, small caps are the most frustrating sector in the world to trade. Ask any trader down here. When they go quickly. We had a 9% rally in the beginning of July. Last year, between October 23rd and December 23rd, they were up 20%. It could never sustain. Right now, with rates being where they are, it's going to be tough for them to really lead. Will they do well? Yes, I think they'll be okay. We're seeing earnings growth in the small caps, but what we're not seeing is an accommodative Fed, interest rates that have been stable and stayed a little longer and we never got back down under 4. We'll see where it goes, but right now I think large cap, mid cap growth is where the story's going to be. Small caps, we're going to have to just kind of pick the gems out of there, and that's the hardest thing to do.
Is the sort of the feeling that we're getting in the markets now that there's this uncertainty with the Fed, and that's creating the volatility in the markets because we don't really know which way the Fed's going to go?
Yeah, I mean, the Fed is always where we focus on everything first, and then we go from there. And then what does the Fed focus on? Inflation, unemployment. So the volatility goes to the uncertainty of the Fed. We had 2 dissenters over the last 3 meetings. You don't see that happen very often when the Fed meets. And then Jerome Powell at the last meeting was a little wishy-washy. We could have cut, we could have kept them the same way. And then the dot plot was a little, it was a very hawkish cut, and that got the market confused. So you ask about volatility, that caused a lot right then and there. Since then, haven't seen much Fed speak, but Fed speak will pick up first full week of January, and yes, I think the volatility will ensue as well.
I'm curious if you think the Fed made mistakes in this rate cutting journey, that maybe it came out too strong with the 50 basis points at first, and now kind of pulling back. It seems like it's either one way or the other,
Don't
right?
get me started on the mistakes they made. They didn't raise them fast enough. They were slow to do that, so they were behind the curve when we started the hiking cycle, and then it had to be the fastest rate hike in the history of rate hikes. And then the cut. When we had that cut back in September, we cut 50 basis points. The meeting before that was in July. 2 days after the meeting, the unemployment number came out. They decided not to cut. Everyone thought, okay, 25 basis point cut would be in line. Okay, the data's showing that. And then unemployment spiked up and then people panicked. Then we had volatility. August 5th, the Japan yen carry trade on top of the Fed not cutting, and we saw a lot of volatility. So they should have cut back in July. They didn't. They overcut going 50 to make up for the mistake they had in July. And then this last one, all right, we're cooling down. We talked in the last segment, sticky and stubborn inflation. Yeah, inflation has not ticked down since they started raising rates. Okay, unemployment has stayed flat. It's stabilized. That's good. But why did we need one more cut? Why don't we just let things digest, and then we'll go data point at a time, like Powell likes to say.
Are you concerned that there is this uncertainty that the Fed is creating?
Yeah, I mean, definitely. And you put that with the new presidency and a president that likes to kind of put pressure on the Fed to lower rates, yet he's raising tariffs, which are inflationary. So there's going to be a lot of headlines made. Now, we went through a Trump presidency before, 2017. This was the crazy stat. 2017, we were up every month. Volatile headlines. But remember the election and the inauguration crowd, we're going to be talking about that in a few weeks too. But the headlines were volatile, the market survived. What derailed us last time was the beginning of 2018, kind of what I'm seeing now, was tariffs. And the uncertainty around the tariffs, with volatile headlines, with a Fed that seems to be, torn right now about their direction, it could lead to some anxiety.
Yeah.
Market doesn't like that, and we may sell off a little bit. It's okay. Not the end of the world.
All right, Jay Woods, thanks so much for your analysis. Appreciate you here on the show today. Chief Global Strategist at Freedom Capital Markets.